Now, the Dow Jones Industrial Average falling just short of the 12,000 mark today. The last time the Dow Jones Industrial Average was above 12,000, you have to think back to June 19th, 2008. Remember that? That was the early stages of the world financial crisis debacle explosion. Does a return to that milestone mean that all our financial worries are over? Maybe, maybe not. We put together a taking stock think tank to tell us more about this. My guests are Thwaites of Sentinel Investments, managing a mere $23 billion with assets under management. In San Francisco, we have Jack McDonald of Conifer Securities. Conifer carries out trades for more than 150 hedge funds, so he knows what professionals are doing. And we have a professional with us. We have Michael Harkins of Levy Harkins. You're a long-time New York investment professional. Good to have you with us, Michael.
Thank you very much. Good to be here.
Christian, thank you very much for joining us. And Jack, so Christian, I mean, you're a pretty sober investor. I kind of remember you're always telling us you don't necessarily want to buy a dollar's worth of assets with a dollar. You would like to buy it maybe 50 cents, maybe even 60 cents. Does where the market stands right now, particularly stocks, does this make you a little bit nervous about spending new money?
A little bit nervous because we've had such a big run up, and the last run up from the summer lows is approaching 25%. So we've had four, whipsaws within the space of about 18 months. And I think at this point the earnings are just about keeping up with expectations. But we expect a little bit of a roll-off February. February's historically not a very good month, and I think the market's got an awful lot of money coming at it right now, which I don't think it'll be able to absorb coming into the next couple of months.
Jack, what do you think? I mean, you hear from professionals. Is that jibe with what you're learning?
I think it does. There's a lot of money, as Christian said, coming in here, and I think the challenge is going to be for investors to put that money to work at a tape that obviously has been strong. Particularly December was a strong month. People locked in some nice gains. The earnings have been better than expected, and I represent more of the hedge fund clientele, and there's always a lot of pressure in strong markets to keep up, and obviously in tougher markets to preserve capital. So it's a tricky time right now in the investing community, and I think a lot of it goes to what the earlier comment was, a general feeling like the market could pull back here, and where do you want to remain having your exposure, and where do you want to remain invested?
Michael Harkins, bring us down to earth, because I know that you look at the market as a market of stocks, not a stock market, and what you're seeing in terms of the companies that you are invested in, how are they doing?
They're doing remarkably well. This has been a remarkable period in American capitalism where profitability has been spectacular, and unemployment is still just an awful problem. It's much worse than the 9.5% headline rate, because when you count discouraged workers and these mystery workers who the government claims are taking the winter off in Aspen, or they've just disappeared from the labor force, that's 17.5% of all the labor force. So spectacular profits with grim employment statistics is just something we haven't seen before.
So what does this mean for someone that has to invest other people's money? Does it make it more difficult?
Well, yeah, we're being driven into the stock market more than most of us actually want to participate, because with interest rates this very low, you can't get returns. If you're running a pension fund or an Mercenary Institute and you've got a 7.5% assumed rate of return, you can know that, and you're the money manager, you can go to the board and you can say, this rate of return is much too high. You'll have 2 meetings at best before they fire you. So what you have to say instead is, I know how to go get 7.5%. And that's why many managers are being driven into the stock market more than they're walking through an open door.
I love that touch of reality. Christian Thwaites, are you finding that you're getting at least 2 meetings?
Well, I think the problem is, we know in the zero interest rate environment and real rates being what they are, there is still a lot of money which has come off a couple of years of strong bond market gains, although we saw that dissipate in the fourth quarter, and they're trying to find the new rates of return. So I think there is a certain amount of euphoria, which I think will sort of slacken off, as I said, in February, March, as this earnings season comes to an end. I think the most important thing about this earnings season is that corporate America has done this fantastic job, and it may be coming to the end of this cycle of having these incredible margins, and now they're coming up in more difficult comp levels. So I think that's kind of setting us up for a slightly disappointing end to the earnings season.
Jack, does this mean that the professionals, the hedge funds that you deal with, are they bracing themselves for a downturn? Are they hedging their bets, maybe buying puts or even going short the market?
Well, clearly, I think that's one of the tenets that differentiates the hedge fund instrument, or the ability to hedge. I want to go back to Michael's point because I think it was very telling to what we're seeing at the Conifer Group, both in terms of many of our managers getting more and more meetings, particularly in the small to mid-size emerging manager segment of the market, where the institutions who have been underexposed to this asset class and this type of alternative investment manager are looking to put more money to work. The larger funds are starting to close, and so that's a good thing from a small to mid-size or emerging manager standpoint. And the other growth trend that we're starting to see again is the startup space. We're busier today than we've been in years in terms of the startup space. People are spinning out of established shops, feeling like the environment is much better to go it alone. And there just generally seems to be a much better vibe, both in terms of the investors who are happy with the hedge fund returns they've received the last 2 years, and also the managers themselves. So it's definitely a better feel than it was back in 2008 when your opening comment referenced.
Michael Harkins, we see a lot of mergers and acquisitions taking place. You got Sarah Lee. You had the deal talking about expansion in energy, in technology, possible IPOs for companies such as Groupon. Does that mean that the market has still got a little bit of room? It might.
This business with these private equity sliver auctions, with Facebook and the like, it gives me the willies because it feels like it's 1999 again. People paying madcap valuations for things that there is no obvious exit strategy right away. That's scary, and when you remember where we were in 2008 and 2009, when public securities were trading like private securities, this going around backwards it's a little too much enthusiasm to. Too much enthusiasm. You agree, Christian? Too much enthusiasm for certain types of assets?
I think the IPO market really has been incredibly dull for about the last 2 years. I think the number of new IPOs on the U.S. market is 45 billion. To strip out General Motors refloat and the others, and there really wasn't much in there, so not too much.
All right. Christian, just during the break, we were talking about this interesting sort of dichotomy between the psychology of the retail investor and, Michael, the psychology of maybe the professional investor, although it's not really the professional investor, it's the client of the professional investor. You got to make that distinction here. And you're both saying that there is some fundamental difference, and it's interesting because it almost seems as though the retail investor has more staying power, Christian.
That's what we've seen. Typically, retail investors have come into the market very solidly the last couple of years into bond markets, and we saw the flows up to about $500 billion a month. Those have slackened off, and people have gone into the equity markets beginning in September, October, which is actually a very good call, with equities outperforming bonds very well. And then we don't see a lot of redemption activity beyond the sort of normal redemption activity of people retiring or moving on or cashing out their 401ks. And a lot of people just stay put in the equity market, which is precisely what they should be doing. So we're actually sort of big advocates of the retail investor. We tend to think they get it more right than wrong.
Michael, what do you think about that?
Well, Chris Brown is my source for this. He says that the average mutual fund turns over its portfolio 150% per annum. How can you even know the stock symbols, let alone who the managements are, whether they understand the importance of digging bigger moats around their competitive positions? Do they really understand?
Yeah, by the time you get the confirmation slip, it's time to buy something else, so you have no idea really what's in the portfolio.
Right, and sensible people just don't act this way. They don't act this way with their own money. And all the pressure that comes on professionals to perform monthly, oh my goodness. No one should know how they're doing monthly. That's ridiculous.
Jack McDonald, what do you think? Knowing how you do monthly, what do your clients want to know? They want to know how they're doing minute by minute?
Well, our clients, certainly the hedge fund managers and the alternative managers, want to know how they're doing minute by minute. But I would say that we're seeing a lot more demand, and this has been a trend that we've seen for a couple of years now, where the institutional investors, so our clients, if you will, want to know more about the portfolio, want to know more about risk and attribution, et cetera. You've got a lot of demands increasingly for greater transparency into the portfolio, and it's one of those double-edged swords because many managers don't want to give away the secret sauce of what they're investing in and how they operate, and so there tends to be a lag in most cases. There's some vehicles that can get around that, like separately managed accounts that offer greater transparency, but by and large, I would say we're seeing an increased demand for transparency into the portfolio. I would touch on one other point also about the retail or the high net worth investor. We are starting to see them rejoin the party. They were, I think, quick to leave the hedge fund industry in 2008. 2010, you may have seen some stats on this, but more assets grew in the industry in the fourth quarter of 2010 than ever before. 150 billion of money added to the industry. Many of those dollars through performance, many of it through inflows. And I think you will see more and more individuals, high net worth families, family offices come back. And at the same time, the big institution, endowment, pension, foundation fund, that's an underallocated strategy as well. And so there's a lot of reasons right now to be bullish on the asset flows into the hedge fund space.
Christian, I know you want to come in on this topic.
Well, I think some of those trends are happening on retail. More transparency certainly is something which the industry is trying to respond to. But the turnover numbers are not quite as bad as the averages suggest, because if you strip out the ETFs and the index funds, which typically have very high turnover, actively managed funds who take a long-term view, like Sentinel, we only have about a 25% turnover. So I think some of the trends towards holding stocks for longer, buying more on fundamentals, buying on the dips, coming through in retail actively managed funds, and that's a good that's a good.
How would you counsel an investor right now that is thinking about putting more money to work in stocks, but wants a little bit of they're lacking in confidence?
Do it carefully, and buy stocks with dividends. I mean, dividends typically make up 30 to 40% of the total return of a portfolio over time. In some years, like 2008, it's well over the total return. Last year was about 40%, in line with the long-term average. So make sure you're getting paid in cash by a strong balance sheet company.
Michael, you're shaking your head. Well, how would you counsel your client base right now?
Well, we believe in looking at cash flows and looking whether cash flows are real, and I've told you many times, somewhere between 2/3 and 3/4 of all the stocks, all the companies that are listed in the value line survey, they never make any real cash over time. Nobody pays a dividend with a promise. You pay a dividend with cash. So what you're talking about actually is right up my alley. These are companies that can come through again and again with good returns, and they don't get diluted horribly when times get tough, because they have to go out and borrow money at Dickensian rates, or they have to go issue shares to the government. Citicorp holders can't make a comeback because the number of shares outstanding has exploded by 10 times. Doesn't matter whether the business gets good again. It can't get back to where it was because there's too many shares outstanding.
We're going to have to leave it there. I want to thank you very much. Michael Harkins coming to us from Levy Harkins. Always a pleasure. Christian Thwaites from Sentinel Investments and Jack McDonald from Conifer. Thank you.